Hi there, I'm Sean O'Keefe, real estate CPA at Digby. Today I'm here to talk to you about material participation and how to qualify specifically as a real estate investor. So first, the IRS would define material participation as a real estate investor who's actively involved on a regular, substantial, and continuous basis in the management of their real estate property. Okay, so there are technically 7 tests to be able to demonstrate this active, substantial and continuous involvement. You only need to meet one of those 7 tests. I will be covering 3 of the most common tests that real estate investors usually qualify for, but you're more than welcome to review the other 4 on your own time. So the first test is that you need to do 500 hours or more on an annual basis in a tax year to qualify for material participation in your rental property. So if we take 500 hours divided by 52 weeks, that works out to be roughly 10 hours a week, which doesn't sound like very much, but for some long-term rentals, they don't require a lot of work, so that might be a little bit more difficult. So let's go on to the second test to see if we could meet the second test. So the second test doesn't have an hourly allocation of time that you need to meet during the tax year. It just says that you need to be doing basically everything. So it would be more difficult to qualify for the second one if you have some other people supporting you with cleaning or something like that. The third test is only 100 hours of material participation during the year, right? And so if we take 100 hours divided by 52, that's only 2 hours a week. But there is a catch on this one in that, in addition to the 100 hours per tax year, you need to be doing more than anyone else who is also involved in this property. So if you have cleaners who are involved in the property, then you need to be participating more than they are. Okay, so those are the 3 most common tests that real estate investors qualify of the 7. Now, let's talk a bit about what indicators the IRS says are red flags that you aren't, substantially, actively participating in your property, and as a result, that you wouldn't materially participate. So one of those is that you live hundreds of miles away from the investment property. So kind of difficult, to be actively involved in this property when you live hundreds of miles away. It's not to say it's impossible, but the IRS would say, in their technical audit guide, that this is a red flag. A second red flag that you're not materially participating would be that you have a property management firm, or that you have someone else, a foreman or a relative, who's actually managing the property. So these are some things to keep in mind as you're trying to evaluate whether or not you qualify for material participation. Finally, there are some common questions that we get around material participation. And one of those is, if you have a married couple who has a rental property, can you combine the hours of participation between a married couple in order to meet the hourly requirement for material participation? And so the short answer is yes, you can. Okay, so the final thing that I would say you need to next explore is what hours count. The time that you're spending, not all of those hours will count toward material participation. So things like calling to get repairs, or doing repairs yourself. What about education? These kinds of things. So what hours actually count toward that 500 hours or the 100 hours in order to qualify? And so that's outside of the scope of this video, but we do have another video and article that covers this in detail. So I would encourage you to go and explore that